All right, so you know how sometimes you look at a company and the numbers are telling you one thing, but the stock price seems to be singing a completely different tune. That's kind of what we're grappling with today in our deep dive into Arista Networks. ANET is the ticker. I mean, look at it now. It's sitting around, what, $86.74? And it's been taking a hit, down almost 4% just today, and, well, down a chunky 20% over the last 6 months. Plus, you've got these technical indicators basically flashing warning signs. But then, and this is the interesting part, you peek under the hood, look at the actual business. It looks incredibly solid, really robust, and analysts, surprisingly bullish, actually. So it's this real tug of war, isn't it, between the market action right now and the company's fundamental strength. That's what we want to unpack. We're digging into the financial metrics, the latest news, technical analysis, trying to figure out this paradox and, what it tells us about how markets work sometimes.
Yeah, it's fascinating. What you're describing with Arista, it's just a classic scenario. We often call it a great story stretched valuation.
Mm-hmm.
The market's basically trying to balance, the company's really ambitious future potential against its current share price. It's almost like the business itself is firing on all cylinders, setting records, but the stock maybe pausing, catching its breath a bit after a really strong run-up.
Oh, okay, so if the stock's catching its breath, let's talk about the sprint the business is actually on. What makes Arista's story so great? Where are these strong fundamentals?
Well, if you look at the big picture, those valuation metrics, they definitely scream high hopes, high price. Take the PE ratio, for instance. It's sitting at 52.3x.
52? That's
Yeah.
pretty high for tech, isn't it?
It is, yeah. It's a premium compared to historical averages. It signals that investors are really pricing in some significant growth down the line.
Right.
It's not just a high number. It suggests the market thinks Arista deserves it because they expect it to grow way faster than your average tech company.
Mm-hmm.
They're betting on future earnings, not just today's. And then look at the EPS growth, earnings per share. Basically, the profit per share is just stellar.
Yeah.
Last quarter, 26.8%. And for the full year 2024, they're projecting 34.6%.
Wow, 34.6%.
Yeah, and that number, I mean, to put it in perspective, that's nearly double the industry average for networking companies. It shows Arista isn't just riding the AI wave. They're actively grabbing more market share within it. They're looking like a dominant player, not just, another participant.
A leader in building out that AI infrastructure.
Exactly. Plus, their forward guidance looks healthy, too. EPS is expected to rise to $2.68 in 2025, up from $2.27.
With growth like that, I guess it's no surprise the analysts are pretty keen. What's the latest news that's got them so optimistic?
Absolutely. I mean, the news really hammers home Arista's aggressive push into AI networking. And this strong alignment, between their strategy and the market's excitement about AI,
Right.
well, that creates a really powerful narrative, doesn't it?
Right.
They're actually targeting $750 million in AI-driven revenue for 2025.
$750 million just from AI.
It's just from AI. And they're already heavily involved in 4 major AI cluster buildouts. You see this reflected in the analyst targets, too. Citi and Redburn Atlantic, both pegging it at $112.
Okay.
Barclays is sticking with an overweight rating. Their target's even higher at $119. And then there's the leadership news. They've hired Todd Nightingale as president and COO. He starts July 1st, coming over from Fastly. Before that, Cisco.
Ah, interesting background.
Right. It really underscores that management is serious about not just capturing, but really scaling up these huge AI and cloud opportunities.
So great growth, big AI push. But I've also heard people talk about Arista's fortress balance sheet. Is that just hype or is there substance there? What does that mean practically?
Oh, it's definitely not hype. Let's look at the numbers. Their ROIC, return on invested capital, an impressive 29.5%.
29.5. Okay, what does that tell us?
That's elite capital efficiency. It means for every dollar they invest back into the business, they're generating almost 30 cents in return. It really points to excellent operations. They're not just growing, they're growing smart, efficiently.
Got it.
Then you look at their net income margin. It's an astounding 40.7%.
40% margin. Wow.
Yeah, think about it. For every dollar of revenue, nearly 41 cents drops straight to the bottom line as pure profit. That's just exceptional efficiency. It suggests they have strong control over costs and real pricing power in their market. A huge advantage in tech.
Definitely.
And financially sound. Their debt-to-equity ratio, which compares debt to shareholder equity, is incredibly low, 0.6%.
0.6%. So almost no debt.
Pretty much. Anything under 1.0 is generally seen as strong, so 0.6%. They're basically funding themselves through their own earnings and shareholder funds, not borrowing much at all. That gives them huge financial flexibility. It really is a fortress balance sheet. Makes sense. And it's worth noting, too, they don't pay a dividend. All those profits plowed right back into growth, which, fits perfectly with those high growth ambitions we talked about.
Okay, so fundamentally, it looks like a clear winner, right? High growth, rock solid financials, big AI story, analysts are happy. The great story part is undeniable. But like we said at the start, the stock's been struggling. So where does this stretched valuation argument come in? What's causing this reality check in the market?
Well, that's the crux of it, isn't it? That tension. While the story is compelling, you look at something like Investing Pro's fair value estimate. It's actually flashing a potential downside of negative 19.6%. It puts the fair value around $69.78.
Minus 19%. So significantly overvalued based on their models.
Exactly. It suggests that, based purely on current fundamentals, the price might have gotten ahead of itself. And some models put that fair value even lower, maybe $67.28.
So even with those great numbers, there's a strong analytical voice saying, hold on, the price is too high right now. And if that valuation warning wasn't enough, you mentioned the technicals earlier, sounds like they're adding to the caution.
They really are, yeah.
Yeah.
If you look at the charts, the patterns, the indicators traders use, they paint a very different picture from the fundamentals right now. Pretty much all the hourly and daily signals, things like RSI, the relative strength index.
Right, that measures momentum.
Yeah, it measures the speed and change of price moves.
Right.
And mass ED, moving average convergence, divergence, which helps spot trend changes.
Okay.
And various moving averages, which kind of smooth out prices to show trends.
Yeah.
They're all pointing towards a strong sell.
All of them. Strong sell.
Pretty consistently, yeah. And the RSI is particularly low, around 24.5. That basically means the stock is deeply oversold.
Oversold. Like a rubber band stretched too tight.
Kind of, yeah.
Yeah.
It suggests the selling pressure has been really extreme. Now, historically, stocks often bounce, at least temporarily, from these levels. But it's no guarantee of a full recovery, just shows how intense the recent selling was.
And the price action itself confirms that weakness.
Absolutely. Down 5.7% in the last month. And as you say, that 20% drop over 6 months. Plus, it's sitting just above a really critical support level, around $86.33.
Uh-oh.
Yeah, if it breaks below that convincingly,
Yeah.
we can see more downside pressure. It's definitely a key level for investors to watch right now.
And are we hearing any institutional voices echoing these worries? Any downgrades?
We are actually. BNP Paribas Exane, for example, recently downgraded Arista to neutral.
Okay, pulling back a bit.
Yeah, and Investing Pro, as we mentioned, keeps highlighting that overvaluation risk. So you've got some professional analysts in these valuation models kind of aligning with the negative technical signals. That's pretty significant.
So let's try and tie this all together. We've got this strong bull case, this great story, and then this quite worrying bear case based on valuation and technicals. How do you reconcile these two completely different takes on Arista?
It really comes down to perspective and time frame, I think. The bull case, as you said, it's undeniably strong. You've got the huge tailwinds from AI and cloud growth. You've got confident management making strategic hires. You've got analyst upgrades. And that incredible fortress balance sheet, that's all real.
Right. Hard facts.
But the bear case, it raises very valid points, too. There's the risk stock is simply overvalued right now. There might be concerns about customer concentration relying too heavily on a few big clients.
Like the big cloud providers.
Exactly. The hyperscalers, people like Microsoft, Amazon, Google, their spending patterns are huge drivers for companies like Arista.
So if they change their spending...
It can create headwinds, definitely.
Yeah.
And then you have those persistent technical sell signals we just talked about. It's just a really nuanced situation. Both sides, the bulls and the bears, they have compelling arguments right now.
Which is exactly why understanding both sides of this coin is so important for you, the listener. It helps you get beyond just the headlines and see the different forces at play in the market.
Absolutely. Yeah. To sum it up, Arista Networks really is that classic great story stretched valuation situation right now. The fundamentals, bullish. Analyst sentiment, mostly bullish. But the recent price action, the technicals, the fair value models, they're definitely urging caution.
So it feels like the long-term business engine is humming along nicely, but the stock itself might just be, I don't know, catching its breath, or maybe facing that reality check after such a powerful climb.
Possibly both. And here's maybe a final thought to chew on. Think about what it really means for a company to have that elite capital efficiency we talked about and a fortress balance sheet, basically running super efficiently with hardly any debt. What does that mean when its stock is seeing these significant short-term drops and flashing sell signals? How might those deep underlying strengths that financial bedrock actually help Arista navigate this market choppiness? Could it even help them achieve those ambitious goals like the $750 million in AI revenue, even if the market isn't quite giving them full credit for it in the short term?